Okay, we're going to jump into our Factum Foundations class tonight. It's one of my favorite ones to teach. We're going to be covering a few main ideas tonight. And if this is your first time tuning into one of our Factum educational classes, welcome. Here at Factum, we're an educational company. We teach primarily in the financial area of life, teaching Americans all across the country how to win the money game. And there's three ideas we're going to cover today on today's call. But the only reason that we would want to show anyone how to win financially is so that they can go out and fund what we would call the ideal life. And the ideal life, or the perfect life, is having abundance in all of these areas. So a strong spiritual purpose, abundance personally with your family. And, I'm very blessed that in the occupation area of life, this is what I get to do full time, is teach people some of these money principles and frameworks that have absolutely set my family free in really less than 10 years. And so we live to be purposeful. We live to teach some of these concepts we're going to talk about tonight. So this concept of abundance in all areas of life is a major idea that we discuss time and time again here at Factum. Now, go ahead and give me a thumbs up in the chat if you can see the screen. Everything's coming in good. We're ready to rock and roll. Okay. So today's agenda, we have about an hour, and I'm going to be moving quickly. We're going to talk about some high-level concepts. You are most likely going to have questions by the end of our hour. I can stay on for as long as you need. Sometimes these go till midnight. No, I'm just kidding. We want to get back to our families. We're going to be covering some high-level conversations today and three main ideas. Like I said, you will have some questions after this. And our goal tonight is just to get you some new education, get you thinking differently about your money. And so idea number one that we're going to spend some time on is what we call the problem. This is a problem every American is experiencing financially. It's the $1 million opportunity cost of how we've all been taught to make large purchases. So we're going to spend a few minutes there tonight. Then we're going to move over to idea number two, which is the toughest asset. There is a timeless asset that has been around for a long, long time. Every American should know about this asset, and more importantly, where does it belong in your wealth plan? Because if you understand that, this is an asset that will help you win through every event in your life. And then idea number three is what we call the reassuring lie and the inconvenient truth. The inconvenient truth is what we're willing to tell the American public, which is no one's coming to save you financially. Part of this wealth game is up to us. It is personal responsibility. It is stewardship. We've got to take more control and more ownership of the financial part of our lives. And if you'll do that, there is a 6 or 7, so I'm talking $100,000 or $1 million fortune waiting for you that you can only control with what we call tough money habits. So let's jump into this for tonight. And let's dive into this idea number one. Now, idea number one comes from this book, Becoming Your Own Banker. So you can see behind me in our recording studio, we have Becoming Your Own Banker, Rich Dad, Poor Dad, The Richest Man in Babylon. We got The One Thing, The Go-Giver, The Compound Effect, and The Pirates of Manhattan by Barry Dyke. All of these books had tremendous influence on many of us on the call tonight, in our financial lives, professional lives, family lives. And this book right here is less than 100 pages long. And in this book, Becoming Your Own Banker by Nelson Nash, he identifies a problem. And he said, the problem in life is you finance everything. Now, when I first was learning about this, I was not aware that this was a problem that I had. And what he means by this is you either borrow money and pay interest, or you were like me growing up, and my dad taught my family, my siblings, to pay cash. And the reason my dad taught us kids to pay cash is because his dad had taught him to do that, and his dad had taught him to do that. And sometimes these generational wealth habits just get passed down the line. A lot of you probably resonate with that statement. And I thought paying cash was the most efficient thing I could have done with my money, but no one ever taught me that when I paid cash, I give up any potential interest I could have earned on those dollars. And the real issue here is that all of these things are financed by other banking organizations. And here's a brief, just financial overview of how this works. Let's say you wanted to make a purchase, and the purchase was $30,000. This could be a vehicle, could be a lot of things. Could be a down payment on a home. If you Instead, put that $30,000 in an environment where you could earn around 4% on it for an extended period of time, in this case, 30 years. It doesn't just cost you $30,000. It costs you $97,000 of what we call interest cost or opportunity cost over that same time period. And this problem affects every single financial decision you make. So we're going to spend a few minutes tonight showing you how to solve that problem in your financial life. And if you do, I'm convinced that is one of the things that keeps more Americans from winning financially, is not understanding how to solve that problem. Now, I love Robert Kiyosaki. We referenced his book, Rich Dad, Poor Dad, up there. A good follow-up book that he wrote is called Cash Flow Quadrant. And if you've ever read this book, that we understand that there's essentially 4 players in the money game. If you were like me growing up, my dad was entrepreneurial. He owned his own business. And so he always tried to tell me, Kyle, you should try to get into business or become an investor like some of my wealthy clients. My dad's an architect. He designs really awesome custom homes. So a lot of his clients had a lot of money. So he'd take me to these homes and I got to see what these investors and these business owners were purchasing. And so there are some advantages to getting into business and becoming an investor. It's not to say that you cannot become wealthy if you're an employee or a self-employed individual, but here's what's interesting. For the first 25 years of my life, I thought these were the only 4 players in the money game that I was able to choose. And it wasn't until I met an orthodontist who was a business owner and an investor at 25 years old, who was teaching other business owners, other dentists, surgeons, orthodontists, hey, you're running your business, you're making investments, you're investing into retirement programs, but who owns the banking function for everything you're doing financially? And this really caught my eye because I was never exposed to this until age 25. And the reality is the bankers influence every other player in the money game. Now, this concept of banking, it's usually not addressed in the big wide world. We kind of just leave this out of sight, out of mind. I want to be one of these 4 players. But when you really position this, like, look at the bankers and where they position themselves and tell me if this does not make a whole lot of sense to you. There's always a saver, and there's always a banker, and there's always a borrower. Now, everyone on the call tonight has been at least 2 of the 3 people in this play. We're the savers, and the savers put money with the banks. The bankers lend money to the borrowers. We've all been the savers and borrowers. There's a few of us on this call that are now the bankers for this as well. And the reason that's significant is because the borrowers pay back the banker at a high interest rate, and the banker turns around and pays back the saver at a low interest rate. And the banks make insane amounts of money by controlling this flow. So the question is, well, what if you became the banker? And this is one of the concepts that if you spend a couple hours reading that book, Becoming Your Own Banker, or watching more of our content, eventually this light bulb goes off in your head and you'll say, oh my gosh, I can see this now. And once you see this, you will never look at the money game the same way ever again. I can guarantee you that. Now, let's talk about this banking problem, because what I was taught growing up was this. Kyle, you're going to spend roughly 20% of your income on automobiles in your life, 30% of your income on housing, about 45% on lifestyle and everything else, and you're probably going to end up saving around 5% of your income like most Americans do. And what typical financial planning had told me is, Kyle, take that 5% you're saving, go put it into investments, whether it's real estate, stock market, whatever, to go get a higher rate of return. And one of the reasons that our company, in the last few years, our company was brought into the Keller Williams space, largest real estate company in the world. They brought us in to help them with some of their foundational wealth education concepts. And the reason they brought us in is because most of the big world tries to tell you how to invest your money with the 5% you're saving. Where we come in, and it's the inconvenient truth, it's going to take a little bit of work, but I would rather have you focus on getting more efficient with the 95% of dollars that are leaving your household every single month. And guess what? You're the only person who can do it. That's the inconvenient truth. We can give you ideas and frameworks here, but we can't go into your house and force you to do any of these things. This has to be a decision that it's got to be important to you, and it's got to be urgent to stop some of this bleeding, if you will. And so I want to show you real quick a concept around how to be more efficient with dollars flowing through our hands, to think more like a banker, to control more of this 95% that's just leaving every single year. And in order to do this, we have to be open-minded to thinking a little bit differently. Now, if you were like me again, growing up, there was two ways to make vehicle purchases in my life. I'm either going to save up and pay cash, or I'm going to borrow money and I'm going to finance it with the financial institution. My dad always taught us, you pay cash, which I did for my first two vehicles that I ever owned. Now, a question I want you to think about. What are the benefits of paying cash? What are the benefits of borrowing? What are the costs of paying cash? What are the costs of borrowing? There's pros and cons to both. And we get to teach this all over the country, and you'll hear different frameworks. I want to pay cash because I get a better deal. I make interest payments. I'd rather finance because I can use that money to go invest and get a better rate of return than what the interest is on the vehicle. There's pros and cons, and there's always two camps. Here's the question that really matters, though. With all of those costs, after all those auto purchases that you've made, how much money do you still own and control? So I want you to think about that. I'll give you about 20 seconds to think about this. Think about all the cars you've owned and driven up until this point in your life. It might be 7, could be 3, 9. How much money do you still have in your control, whether you paid cash or financed those vehicles? I'm going to help you with the answer. It's a big fat 0. My answer used to be 0 too. In the last 11 years, we have solved this problem for our family going forward. You see, anytime that you're saving money and paying cash or borrowing from a different financial institution, you're in a constant state of permanently sending money away from your family for these transactions. This is what we call the problem. It's $1 million opportunity cost for every American the way they're currently making large purchases. And this frustrated me because I thought I was doing the most efficient thing by paying cash. But at the end of the time frame, I'm going to have $0, the same person as the borrower. So what good did it do me? The point here is we got to be thinking differently. If you're only thinking there's two options here, save up and pay cash or finance, then we have to be looking for a different alternative. Now, one of our most popular videos on our educational courses is how to use this concept we're talking about tonight to finance vehicles over your lifetime. So make sure whoever invited you tonight, you ask them for the video. Write this down if you're taking notes. IBC and vehicles. It'll walk you through what does it look like if I pay cash for vehicles? What does it look like if I use a bank to finance? What does it look like if I try to self-finance these vehicles? Okay? Now, the average American is going to drive 13 vehicles in their lifetime, spending roughly $400,000. That's principal and interest combined. And they're going to end up with 0. Now, if you're willing to watch a 10-minute video that we're going to send you after this call, I'll show you how to spend the same $400,000, but you got to think more like a banker and a wealth creator, and you're going to end up with well over $1 million in your control just by making large purchases a slightly different way. Now, I hope everyone on the call is willing to spend 10 minutes of their time to watch a video that could change the entire trajectory of how you're going to make large purchases in the future. And I'm going to take that same concept for vehicles, and I'm going to show you a little investment I made with my wife several years ago, okay? So let's move on. Who owns the banking function? Here's what's happening in a nutshell. We deposit money with a bank. Now, there is an asset that banks love to own that they don't necessarily want you to know about, because if you knew about this, you would probably put some of your money there and they would lose some of the control of your dollars. And so my family uses a very specialized type of whole life insurance as a private banking tool. I'm going to show you why in just a minute. And one of the benefits I get by storing some of my cash in life insurance is I'll get a more competitive yield on my savings. Now, once I have money in this policy, I can lend it out to acquire things like real estate, vehicles, business and investments, part of my debt strategy. Now, typically in this function, we let a commercial bank own all of these transactions and this flow of money for us. And hopefully we're willing to spend a little bit of time getting educated on the concept of banking and how that actually influences, because today, my family uses a private banking tool. We call it this life insurance contract to finance all of these things that we were going to make anyways. And the difference is millions of dollars of control for my family's wealth. So make sure you ask for some of the additional resources when we're done tonight, and we're going to show you real life examples of all of that. Now, here's why I saw this from an orthodontist who was 65 years old when he first started buying these life insurance policies. And he said, Kyle, with your age right now, this would be one of the smartest decisions that you could start implementing. And so this is a policy, the first policy I ever bought, actually. And I'm coming into the 13th year on this thing. Now, my wife and I have been saving around $8,000 a year into this policy. And when I was first buying this, people told me, oh, you're crazy. Those are the worst things you can ever buy. They're expensive. They don't work. I went against their judgment, and I decided to go with my gut and learn from this very successful orthodontist. One of the best decisions I ever made, because in this next year, I'm going to save in $8,000. We would call that premium. And that policy is going to grow by $13,000 that very next year. Or it grows $1.63 for every dollar I put into this on a guaranteed basis, no risk, not attached to the stock market. Now, this is one of the greatest places my family has to store wealth and savings. If I go another 15 years, year 28 in the policy, I put in the same $8,000 of savings. It's going to grow by $24,000 that year, or $3.10 for every dollar I put in. Now, anyone that has one of these specially designed whole life insurance policies that's like 5, 10, 15 years old, they all say the same thing. I wish I could put more money into that asset because there's no risk for it to grow and compound. Now, this is not your average life insurance you can just go buy at State Farm. I'll tell you that. It's got to be very specialized, designed properly with the right carriers, and you got to have the right guide on that journey to help you use this properly. A lot of people might have life insurance, but they do not know how to use life insurance. There's a big distinction there. If we go another 15 years and I pay the minimum, so these policies are real flexible. You can save in a little bit of money, you can save in a lot of money. And if I pay the minimum in that 43rd year, I pay in $2,600, it'll grow by $36,000. By the way, none of that is taxable. Powerful, powerful place to store wealth. It grows $13.50 for every dollar I put into that thing. This is where my family intentionally saves money to then go make investments, to then go finance vehicles. This is just an extra pit stop. We're going to cover that in a minute. Now, I am absolutely convinced that every American could win the money game in a 5, 10, or 15-year time frame. And what I mean by win the money game is they could get in a position financially that they probably never thought they could be in. But most Americans are playing the wealth game by themselves, which is a huge mistake. You're playing the game solo. You need a wealth team. And most of us don't have the proper sequence and frameworks to build wealth systematically. So what does it end up looking like? We take random chances and we just speculate when we probably think we're investing, and it's why we constantly lose money every 5 to 7 years. If that resonates with you, you really need to hop on a call with one of our Factum agents who can guide you through where you're currently at, where do you want to go, and we've got the right tools, frameworks, and processes to get you there. So that's idea number one, is the problem, the $1 million opportunity cost of how we're making large purchases. Part of that is a banking conversation. You got to get a hold of that book. You got to get some of the additional resources from our company and watch some of these videos. They'll absolutely change your life. So let's jump into now idea number 2, the toughest asset. Why would I buy one of these whole life insurance policies? Well, when I was studying and I was reading books like The Pirates of Manhattan by Barry Dyke, and Barry Dyke has done more research and investigation into who's really buying what, where do the wealthiest companies in the world store their wealth. And when I started researching this, I found that commercial banks are some of the best players in the money game. And they're also some of the largest purchasers of this type of insurance policy that we're talking about tonight. That really made me curious. So Bank of America, Wells Fargo, Chase Bank, these numbers down here, 24 billion, 19 billion, 12 billion, This represents something called BOLI, which stands for bank-owned life insurance. What really frustrated me is I had never heard that these banks were storing more of their savings with life insurance companies than they were their own banking colleagues, if you will. For instance, Bank of America does not save money with Wells Fargo. They put a lot of their long-term storage of wealth into these insurance contracts, and I really was curious as to why they would want to do that. And what I found is, what I was commonly hearing about whole life insurance from I'll say like middle class and like my uncle who knew everything about money but never had any money. Do we all have someone like that in our life? Oh, those are terrible, Kyle. But this guy doesn't have any money. So it's like I didn't want to take advice from people who didn't have what I was looking for. That doesn't mean people that don't have wealth don't know what they're talking about, but you get what I'm saying. And what everyone was telling me back then is whole life insurance has a low rate of return. It's expensive to own. It's the worst investment of all time. And what I found doing my own research and buying this and owning it for over 10 years now was that whole life insurance is not an investment. If you're taking notes, I want you to write that down 2 times. If you're looking at insurance as an investment, you're going to be so confused as to how this thing fits in your wealth plan. I mean, it's not called whole life investment, right? It's called whole life insurance. And insurance is a protection and a control conversation. That's why the banks love it so much. It is a huge piece to their wealth plan. It offers them certain unique benefits that we're going to see right here on the screen that you will not find in any other singular asset. So these 8 benefits on your screen are what make whole life insurance the toughest asset you can own. And it's because of the guarantees. So why do the banks love this so much? They get a guaranteed contract, which can extend over 100 years. So they get a guaranteed contract that their cash will always be compounding. It's always liquid and accessible. It is very private. There's a death benefit, or what we would call an income tax-free transfer of wealth. There is a very competitive yield on the growth of these policies. Your cash value is going to increase every single month. So you'll actually be excited to save money here because you're going to see it go up every month. And then they have options to use what's called a flexible loan provision. Now, since this is a high-level foundations class, we're not going to go deep into all of these benefits, but we have resources if you want to look deeper into how all these interact with each other. Basically, there's no other asset that has these 8 benefits built into one place, and especially not with any type of guaranteed contract. And this is why the banks love this asset. It's why my family loves it as well. And so let me give you a few examples of like who's buying this stuff and why. We have a lot of adult clients that once they see this, they're like, I need to start some of these policies on my kids. So this is a client that's been with about 6 years. They put this policy in force on their 1-month-old baby. This little guy is 6 years old now. And the parents were saving anywhere from $1,500 a year to about $3,000 per year. You can do more than that. So these policies are real flexible in how you can fund them. But those parents own and control the policy. It's on the life of their child. And they're using this to handle some of the future financial needs of the child. So they got $23,000 of what's called cash value. That's that column in blue right in the center. And what's cool about this is that little policy grows $131 every single month, no taxation. And he's insured for just under $700,000. Now, here's the inconvenient truth. All of us on this call have a 100% chance of passing away sometime in our life. And one of the biggest regrets we hear from clients that we work with is, how did I not know about this sooner? I wish I could have started this 20 years ago. And so a lot of our adult clients that see this, they rush to go put some of these smaller policies on some of their children. It's nothing more than, you call it maybe a really aggressive savings environment for your kids that has those additional benefits built into it. Here's a 25-year-old that saves $4,000 a year, 10% of his income. He's got $22,000 of cash value built up. His policy is growing $183 every single month. I'll tell you, I cannot find any commercial bank, not in the entire country, that would pay you any type of yield like that and give you a guaranteed death benefit as well. This is a 35-year-old that works with us, $8,000 a year in premium. They got $87,000 of cash value built up in that policy. It grows $480 a month net of taxes. I mean, that is an incredibly efficient place to store wealth. That beats a lot of the real estate professionals we work with. That will beat some of the cash flow on their actual investment properties they own. Now, this is not an investment. Where this gets fun is when you use this savings environment, this policy we're talking about, to fund some of the investments later in your life. Here's a 66-year-old gal that works with us who pays about $10,000 a year premium. That's how much she was comfortable saving. She's got $73,000 of cash value built up. Her policy is growing $535 every single month. But that's not really why she bought the policy. She bought it more for estate planning needs. $300,000 of guaranteed windfall that'll go to her estate. That's her 3 kids. It could be her trust. And she bought it just because she needs cash to hit her estate in case any unforeseen events happen, because she doesn't want to lose the land that's been in her family for over 90 years. So there's a lot of different strategies you can implement with this. Here's an investor in Texas that we work with. And this guy kind of put in like a lump sum. So we got some clients that have a lot of cash sitting. So they'll put in like, $10,000 up front. This guy put in like $100,000 up front and then pays like $25,000 a year. That's his comfortable, affordable number. So he's got $187,000 built up. His policy is growing $1,200 a month. And this guy invests in real estate. So he said, I can be more patient looking for better deals because the yield on my savings is so aggressive. It's so competitive. I can wait for better deals. And here's a younger business owner I work with here in Arizona. He's been with me about 6 years. This guy has larger premiums, we'd say. He saves anywhere from $250,000 a year. This year, he put in about $900,000 into his system. Now, the reason he's getting more aggressive with this is now that he's seeing it really grow, he wants more of his cash in that asset. So he's got $2.2 million of cash value, and his policies are growing $17,000 every single month net of taxes. And so what's really cool about this is that 6-year-old child and this multi-million-dollar business owner and everyone in between is getting the same 8 benefits. Now, most of us, with where we hold our savings, with a commercial bank in a checking or savings account, we're getting 2, maybe 3 benefits. It's accessible at the bank, it's safe, and hopefully they're paying us some type of yield. But it is not private. There's no loan provision we can use for it. There's no death benefit attached to it. And it's not necessarily going to grow every single month. So we're always in this mode of trading off benefits. So let's talk really quick about this path of money. This comes from a billionaire, actually, Gary Keller. And this is our version of what he calls the path of money. Basically, there's 4 things you can do with money as it flows into your life. You can spend it. The second thing is you can donate it. The third thing would be called saving. So after you've spent money, you've donated money, what's left over is called saving. So the third thing you can do is hold money, with the fourth thing being investing. Now, hopefully you're investing into assets that create income or cash flow for you that will help set you free over time. And your life insurance policy and where Factum exists, the reason our company was brought into other companies like Keller Williams is to not help them with their investing conversation. It's to help them be as efficient as possible with this green box right there. Where do you hold and store your cash and cash reserves? We think a good portion of that should be in life insurance because of those 8 benefits. That's what makes it such a tough asset. So I'm going to tell you this again, because as you're watching this, you're going to leave this call tonight. You're going to talk to someone tomorrow, a sibling, a parent, a coworker, a business partner, and you're like, hey, I listened to this class about banking and whole life insurance and building tough money habits. And they're going to say, oh, don't you dare do one of those whole life policies. It's the worst investment of all time. If you ever hear someone call whole life insurance an investment, you now know that person has no idea what they're talking about because they can't even correctly identify what it is, okay? So I'm going to give you a little cheat code to those conversations. Just know they're coming, because I heard it all the time at 25 years old. Now I'm 37. Everybody wants what I have. They just don't want to go through the work to actually build the structure and the systems. And that's part of the inconvenient truth. So let me share with you a quick example. Here's how it typically works. We have a hold category where we hold cash reserves, and then we have an investment category. And this is how it typically works. We save up money. Let's say we save and we work and we grind and we scrimp and we get $50,000 saved up. And then we have an opportunity to go invest it in the stock market, into real estate, to buy a business, to make a loan, whatever it is, whatever your investment criteria is. So we move the 50 grand from the green box, the hold category, which is usually a checking account, to the investment. Now, if we have a good investment criteria, we should have new money that flows back into our savings account. So hopefully if we invested 50 grand, we should see more than 50 grand coming back into the checking account. So what do? We start accumulating savings again to go repeat the process. And the issue here is you're always in a constant state of interrupting any potential that your savings was trying to create for you. So what do? We're just going to add one more option. I'm going to use a bank account. I still do, full disclosure, okay? But I take a lot of my long-term savings, and instead of leaving it at the bank, I'm going to roll it into an insurance policy, because I want those 8 benefits that the banks aren't willing to give me. And as I build up what's called cash value, which is very similar to like what you see in a checking account when you log on to like Chase Bank app, I'm going to use that as part of my investing strategy. But this time, my wealth is going to be permanently working for me. Okay, I'm going to talk to you about that in just a minute. And I want those 8 benefits we referenced, but more importantly, I want them permanently in my life. So let me give you an example. When I was 25 years old and I bought my first policy, everyone called me crazy, just so you know. That's the worst thing you could ever do. And, you know, using cash to buy my first home would have cost me $180,000 in interest cost, okay? So this is going back to idea number 1, the problem. You either pay up interest or you give up interest with every transaction. This is one of the ways that you can stop that problem in your life. Using my whole life policy loan to acquire our first home added over $1.3 million to my wealth plan. This is the best part, guaranteed. We're not used to using that word guaranteed in the financial world. It's one of the reasons banks love life insurance carriers, because they offer them true guarantees on their money. So let's take a look at this. This is Kyle Fuller, impact on my wealth plan. Option 1, in 2020, during COVID, my wife and I purchased a single family home for $335,000. The down payment needed was $17,000. That checking account that I had money in was earning nothing, 0.01% gross. This is why people hate savings, at least one of the reasons, because it doesn't do anything. If I take that $17,000 out and I just go buy the property, that 17 grand is gone forever. I lose the ability to earn interest on 17 grand. And that costs me $179,000 by age 90, assuming I could have earned around 4% on it. So here's what we actually did. I took that down payment, that $17,000, I put it into a life insurance contract I already had that earns about 4% net long term. So now immediately that $17,000 will stay on my side of the equation and I'll earn interest on it for the rest of my life. It is permanently in my control. If you're option 1, you are in a state of permanent transfer of money away from you. Understanding banking is about permanently keeping the control on your side of the equation. Now here's where it gets interesting. I took a policy loan to go buy this property now. And I did pay about $2,000 of interest to use the loan provision on an insurance contract. Once again, we've got videos that I'll send you after this to tie some of these concepts together. Now, 2023 rolls around. My wife and I have lived in this home for 2.5 years. The appreciation was so aggressive during that time frame in the Phoenix area. We sold that home 2.5 years later for $550,000. So we made $200,000 of net profit selling that home. Option one is I could take that $200,000 profit and put it into something really safe and secure with no risk, like US Treasuries, which have earned about 2.6% net growth over the last 60 years. And that would have earned me about $935,000 by age 90. Not a bad plan for selling off one investment and putting it in the most safe, secure place I could and just let it ride, right? No more risk on it. We're just going to capture it and control it forever. What we did instead is we put it into some policies that we own now, earning closer to 4%, which the interest earned over that time frame is going to be about $2.1 million. Or this was a best case scenario, $1.3 million increase to my wealth plan by age 90, just by adding that one additional step in there. So let me just walk you through for the visual learners. Here's 30-year-old Kyle. This was 7 years ago now. I have like $60,000 sitting in an insurance contract. I find this single family home. That's my wife and at that time 2 kids. We now have 4 kids. The down payment needed was $17,000. So I call up the insurance company. I say, I got 60 grand in my policy. Will you loan me $17,000? They say, great. Yes, we will. You've got plenty of cash in your policy. They don't ask me what it's for. They don't ask you for an amortization schedule. They don't check your credit. It is the most flexible loan option you will ever get. And I still earn interest on the full $60,000 in there. So we take the loan, we put it into a bank, we go buy the property. 2.5 years later, we sell it. We make $200,000. We pay down that line of credit, which frees it up so we can use it again. And the additional cash flow goes right into that policy. And then we earn guaranteed interest on that entire cash flow for the rest of our lives. Now, where this gets really fun is when you start stacking investment wins like every 2 years, every 3 years. This was just one example here. So there's a lot going on there. I want to just recap this point. If I just use a bank account for any major transactions, investments, vehicles, equipment for your business, vacations for your family, whatever it may be, you're always in a constant interruption, whether you're a saver or a borrower. If you use a whole life insurance contract, you're going to be in this constant state of compounding, okay? So what everyone told me 11 years ago was, oh, you are crazy. You shouldn't be buying these. They got a low rate of return. They're expensive to own. And you will probably be behind the cash pay guy for the first several years of this policy. But now you get it out to 10 years like I have it, and the compounding is so aggressive. Everyone else is still at the same spot. I am light years ahead of them in the wealth game just by having a more efficient place to store my savings. When you see this, you will never be able to unsee this again. And we have some videos we want to send you after this that'll help you break down the math and how this is flowing. Most people need about 7 to 8 hours of education around this concept before they go, oh my gosh, it just clicked for me and I get it. And once that happens, you'll never look at money the same way again. And so most of us, if we're starting this journey, it's going to feel a little bit slow. But the longer you do this, the more aggressive that compounding gets. And the greatest part is I've never had to restart my savings in the last 11 years. That gives me one of the greatest advantages in the money game. So why is this important? Having the right team on your side and understanding how to own the toughest asset as part of your foundation, this is going to help with unpredictable income. So if you've ever experienced wild swings of income in your life, having a policy that constantly grows for you will help alleviate some of that pressure. If one of your problems is we can't stop spending so much money, it's way easier to save money when you have a policy that gives you so many benefits. It is difficult to save money with a bank that gives you 4 cents and a sucker when you walk in. And we've put hundreds of thousands of dollars with these commercial banks. If you feel like you have too much reliance on credit and you want to get away from that broken system, the bigger your policies get, the less reliance on typical credit you'll have. If you feel like you're always pinched for cash, You're not carrying enough liquidity. That might be where your financial pressure is coming from. Having a policy that's constantly working for you makes it easier to hold on to cash longer. And if you're like, my biggest fear is I don't know if I'm going to be able to retire. If you're still just keeping the bulk of your savings in a checking or savings account, those will never convert into any type of retirement income stream for you. But these policies that a lot of us on this call are carrying and a lot of our clients across the nation have, you can convert these policies into retirement supplementation, passive income streams, something your checking and savings accounts will never do for you. Those 5 things are where most Americans feel some type of financial pressure. Where you've probably fallen short is you've been trying to do this on your own. You don't have the right guide on your team to get you from where you're at to where you want to go in the shortest amount of time with the least amount of risk. So there's the first 2 ideas. The problem, the toughest asset. Now we're going to spend the last few minutes talking about idea number 3, the reassuring lie and the inconvenient truth. So, are we blessed to live in the United States? Is that something we can all agree on?
Absolutely.
I really hope so, because we teach this all over the country. We've taught this to tens of thousands of people, and we get to work with so many amazing leaders, families, young kids just starting out in the money game. And what I hear all the time is, Kyle, if I could just make more money, that would solve all of my financial pressure. Now, I'm always in favor of making more money. I think living in the United States is one of the greatest places for us to find opportunity to increase our income. Now, I'm going to take us through a little bit of an awareness exercise. This is the inconvenient truth. If you make $50,000 a year, you are in the top 50% of income earners. This is a household together. If you make $99,000, we'll call it $100,000, you're in the top 25% of income earners. If you make just over $175,000 per year, you make more money than 90% of Americans. If you bring in about $260,000 per year, you're in the top 5%. And if you're in the top 1% of income earners, you're making well over $600,000 per year. Now, when we show this, a lot of people we work with say, oh my gosh, I did not realize my income was in the top 50 to 60% of US households. I'm actually doing way better than I thought I was. Maybe, just maybe, income is not the source of our financial pressure. Bonus question, and Wade, you'll have to just look at the chat for me, but I want to know from everyone, what do you think you have to be bringing in? If we take the entire world, we average the worldwide stat to be in the top 1% of income earners worldwide, how much money do you think you got to be bringing in? I'll just give you a clue. We are incredibly blessed with high income in the United States of America. What do you think that number is? Top 1% worldwide.
I'd like to hear a couple comments. Throw them in the chat. Just really quick, what do you think to be in the top 1% worldwide? Any guesses? Let's see what we got here. 125K. 200K. 250K.
250K. Thank you for the participation. I've waited 45 minutes once for someone to answer. That's how stubborn I can be sometimes. It's a very quiet 45 minutes. So we got 125 and 250. Is that what I'm hearing, Wade?
125, 200, 250, 50,000. Greg Wiggins,
Okay.
those 50,000.
Let's take a look at this. Top 1% stat is $34,000. When we show this, the amount of awareness that people have now is shocking. They go, even if I'm making 50 grand a year, I make substantially more money than the top 1% worldwide. That is how high our incomes are actually at in America. So I think it's safe to say income is not our problem in this country. Let me show you what our problem is. It's how much of that income are we actually keeping? This blue graph down at the bottom, that is the average savings rate. As of December of 2025, personal savings rate across the country was less than 5%. Meaning we live in the wealthiest country in the history of the world, and Americans are spending 95+% of their income. This is the first fundamental step you have to solve in order to start getting ahead financially. If you cannot save more money, and when I say save more, you got to start saving between 10 and 30% of your income. If you're not in that range, there's no easy way to say this. You will never become wealthy. If you read books like Becoming Your Own Banker, Rich Dad, Poor Dad, Richest Man in Babylon, Total Money Makeover by Dave Ramsey, any financial book, they tell you the same thing. Pay yourself first, save money first. It's always 10% minimum. That's not a coincidence. It's twice the national average. We have a savings problem in this country, and that bleeds over into a secondary problem. If cash is king, we've always heard this, then who really has it? I'm out here in the Phoenix area, and this is a study that the Chase Institute did with 600,000 business owners. How many days of liquidity or cash reserves are businesses in the Phoenix area holding? 25 days. Meaning, if a business owner in Phoenix goes more than 1 month without income, they start feeling financial pressure. It's why we saw so many businesses go under during COVID, during that event. In about 3 months, businesses were closing shop. They can't survive. Part of that is because they're not carrying enough cash reserves. They're not saving enough. And I believe that's because lack of financial education and really inefficient places to store wealth. Nobody likes to save money in a checking account that doesn't produce anything for them. So, how do we solve this problem? You have to have the right team that's going to help you answer some very fundamental questions to the money game. So we're going to wrap up with this. These are what we call the 5 most important financial questions if you want to build what we call tough money. This is the inconvenient truth. This is going to take some work. There's no magic pill. Your financial advisor is not coming to save you. This is going to take some work on your part. But if you have the right team around you, they can help facilitate and guide you to where you want to go. So question 1 that you need to be able to answer if you want to build what's called tough money. Do you know how much you should be earning in passive income to live the life you've always wanted? That is what's called a freedom number. So your answer might be yes, it could be no. Question 2, do you know how much you should be saving to achieve your passive income goal? We just gave you a hint in the previous slide. If you're saving less than 5% of your income, you will never reach your passive income goal. I will tell you that. You've got to save at least 10% of your income. If you can do that, it's just a matter of time before you end up winning the money game. You got to have the right disciplines. Question 3, do you know how much you should be holding in cash reserves to guarantee your protection and opportunities when events happen? This question is about liquidity. Average business owner is carrying less than 30 days of liquidity all across the country. So, quick story about my family. My parents made great money for 10 years leading up to the event of 2008. My parents were over leveraged investing in real estate when the 2008 crisis happened. And I'll tell you, leverage is really, really fun and exciting until it's not. When that event happened, it took my parents from being exceptional to near bankruptcy in about 6 months. And it's because they did not understand the answer to this question. Are you holding enough cash reserves to protect yourself and set yourself up for opportunities, not if, but when events happen? So my family was obliterated financially in 2008. The families that survived 2008 were able to buy real estate in 2010, 11, 12 at such an insane discount. They literally created fortunes during the same event where my parents were basically going bankrupt. Same event, very different outcomes because one family had tough money and the other did not. I'll tell you, now we have a family that is very tough financially. It took us 10 years to build that though. Question 4, do you know if the current environment where you hold your money, not invest it, hold it, is maximizing the benefits you deserve? Or is your checking and savings account giving you all the benefits you ever dreamed of? That's supposed to be a joke, okay? The banks could give us way more benefit if they wanted, but they choose to give us next to nothing. Maybe it's time to shift where some of our wealth is being stored. And question 5, no right or wrong answer here. How would you rate your current money management habits? In order to be successful with some of the concepts we talked about today, you've got to keep an open mind. Be willing to think about stuff different. You got to think long term. You need to be coachable, accountable. That's the inconvenient truth. There's no magic pill here that's going to solve all your problems. But if you're willing to go through some of our education and work with a few of our guides, they will help you determine exactly where you're at. Are you average, weak, strong, tough when it comes to money management? Doesn't matter where you're at. The question is, do you want to become tough? And I really hope the answer is yes. So this is what we call the Factum 5, the 5 most important financial questions that you need to answer if you want to build tough money. And the question at the bottom, I think, is the most important. Do you want to know for sure? When you go to sleep at night, you got to put your head on your pillow knowing you are tough financially. There's no event that's going to bring you down. Now, your ability to thrive financially over time, not if, but when events happen, will be dictated by how tough is your money. If you want to build tough money, you need to be able to understand those 3 ideas we covered tonight. The problem and how banking affects your financial life, owning the toughest asset that'll help you win through every event, and events could be lawsuits, deaths, divorce, recessions, change in taxation, accidents. Events can take many, many forms. Every time an event happens, if you don't have tough money, you're going to feel it financially. It's going to rock your world every time. When you have tough money and you understand these 3 ideas, you will not only survive those events, but you'll be in a position to actually thrive during them. So, in order to do that, you've got to understand these 3 main ideas. Now, in conclusion, we shared some new education here. And the purpose of education knowledge is action. It's not just, great, we learned something new. When you learn something new, you want to now go apply it. So here's the reality. Here's the current version of you on the call tonight. You got some new education. You now have more awareness. You can do nothing and go back to what you were doing before for the rest of your life, and you're going to stay in that exact same current state. Number 1 point of feedback we get, and we teach all over the country, where were you guys 20 years ago? How come I didn't know about this? How come everyone's not doing this? And the reality is they are doing this now. There are so many Americans that have been implementing this for generations. It's just banks and Wall Street are never going to teach you this type of financial education. So if you decide to do something new and implement this, you're going to create a new version of you, and that's the only way progress is ever made. So what I'd encourage you to do tonight, we have a few minutes left. I want to take any questions you have for me, but make sure you get back with the person that invited you to tonight's class and say, I want to talk to someone, or I want the additional resources. If this is really important to you and this is urgent, you need to meet with someone on our team. If this is not that important and not that urgent, at least let us give you some free education so you can keep learning about this concept. So, Wade, I'd love to take any questions that we have in the chat. If there are any questions, I can hang out here as long as you guys need. We told you we'd get you out in an hour. We're 3 minutes ahead of schedule. Look at that. So if you need to hop off, I don't want to keep you any longer. Go spend time with your families. That's the most important thing we can be doing. And so hopefully we added some value to your life tonight, and hopefully you learned something new.
So we did have a couple of comments or questions in the chat. One that was earlier when you were talking about when you sold your house and you took that money, you put those into your policies. It wasn't just one policy. You did have multiple policies at the time, but you were able to put that money back in. So there's a plan and there's a way to structure these policies so you got the money into it, correct?
That is correct. Now, what's fun is once you kind of get into this, a lot of our clients will have these little, we'll call them starter policies. They just policies that kind of get their feet wet. If you can get good handling a small policy, you'll be good handling a big policy, or what I call a system of policies. So I own insurance on my wife, our 4 kids. I own insurance now on my parents, my mother-in-law, key business partners. So you can expand the ownership of this asset. And once you see it, it's no different than like your first rental property you bought may not be the only property you ever needed to solve all your financial problems. So this is definitely becomes a system and a process that you grow into, and that's where a lot of our courses have been really instrumental for clients learning. You'll do things differently 10 years in that you were not able to do in your first 2 years of starting this process. We'll just put it that way. So you'll grow and scale into that conversation.
Yeah, I think that's really good advice. Is like if you think about it from any standpoint, it's like you grow into what you need typically, and what I know what you guys did was just you kind of planned for that as well. So you had what we call holes or places for those windfalls to have a home.
That's exactly right.
So we have another question asking about are there any age limits I'm going to try to reread this again so I can basically says, are there any age limits for a policy?
So there can be. We have clients, like I said, that start them on, once this clicks for them, they have kids, they try to get their kids insured as early as possible because they have the longest amount of time to compound. But correct me if I'm wrong, Wade, around 80 might be the oldest you might be able to get considered for life insurance.
85, yep.
85. So, and I'll tell you, the gentleman who originally taught me this was 65 when he started. So I don't want to hear it from anyone on the call tonight that you're too old to buy life insurance. Now, I'll say this too. I had people in my life teaching me this who could not get insurance because they had cancer or some issues with their heart that they literally could not get. They were uninsurable. But you can still own policies on other individuals, can pay for it, control it, but it's on the life of another individual. I do this with my kids. So just because you might think you're too old, or maybe you can't get it for health reasons, that doesn't mean you can't participate in this conversation of banking. There are strategies to get around certain things like that. I own policies on my kids. My wife and I own and pay for those policies. We control it, but the insured is our children.
And I think there's some clarification came in the chat. It's like over 50, age 50 as an example. And I'm just going to say as something that's over 50, that is not too old to get rolling with these things. We write a lot of 50 plus clients, 50 age plus clients, because again, they understand it. Their focus is more on legacy and how do I grow this for my family, my kids, my grandkids, and to bring my whole lineage out of bondage.
I love it. Great questions, by the way. Yeah, my first two mentors in this business, one was mid-50s, the other was mid-60s, and both of them did phenomenally well with 20 years of owning this asset.
And I was just corrected. Again, this is just kind of how I am. So thank you so much for the correction. I appreciate that. Are there age limits? You can contribute each year based on your age. So there is, but it's not necessarily on your age. It's more on your income that you're generating from whatever endeavor that you're in. So it's not so much a limitation on age. There's some limitations on age, but it's more derivative of your income.
A great question. This is a sharp crew tonight.
Yeah, and I think that's more of a conversation you have offline with your agent, the person that invited you here, because again, you might have a policy and you may say, well, I want a policy on maybe my parents or maybe my children or whatever it might be. So there are ways to get the income that you want inside your policy for the most part.
I love it. Any other questions for us tonight?
Let's see if there's like Shala says, there's no limitation the same way as there is to a Roth or a traditional IRA. So,
and remember, it's not an investment. This is more in common with a foundational savings environment type of asset. And so you're going to have a lot more freedom and flexibility. We have a lot of clients that will use this kind of like an investment, They'll use their self-directed IRAs or self-directed Roths to make investments. People use life insurance for a similar thing. It's just you have certain guarantees and benefits into there that can really make that whole investing journey. It'll change the game for you, I'll tell you that. And so you want to use it in conjunction with your investments. You want to compare this thing to other liquid safe environments, checking accounts, savings accounts, CDs, treasuries, anything that we would classify as very safe and very accessible. And most investments don't meet that criteria. That's why they're called investments. You're bringing risk into the equation. This is all about mitigating risk and getting guarantees and control. Banking is the exact opposite function of investing. When you put them together, you're going to see this whole different wealth framework that'll change your life forever. All right. Well, I love this. I appreciate everyone hopping on, spending an hour with us tonight. Like I said, make sure you get the additional resources. Reach out to us. You're going to have questions. We have more videos, more content, more frameworks. We teach every single month live. We do what's called a deep dive class. This month, we're teaching it on the family banking business. So if you want to see some of the elements of tonight's conversation applied at a family level, make sure that you register for that class. All of this education for the consuming public is always free. So just know that we want to get our education out there. We have some of the best stuff, in my opinion. And so make sure you stay tied in, you're coachable, you're accountable, and let us know what we can do for everyone in the future.